due diligence and data sources. Okay, so we're still in years 5 to 6. We're getting closer to the Holy Grail, which is going public, which occurs between years 7 and 8. And I can't wait to show you how we do this. It's awesome. Okay, great. So let's move on. Great financial analysts form their own opinions. Others have hidden agendas, okay? But most financial analysts are wrong. And there's so many examples of this. If you look at Barron's, which is probably one of the more relevant financial publications, they're consistently wrong. And quite often when you watch media, talk shows or investment shows, you almost want to do the opposite because they represent groupthink or what everybody is doing. And you want to be contrarian, buy low, sell high. You want to do what no one else is doing usually, okay? And the same thing goes for the qualitative aspect of business where you want to think different. Remember, we talked about that earlier in the course. And so Barron's has walked people off the cliff so many times. I remember years ago, and here's an image, they said Facebook is only worth $15 per share. Another great example is they talked about Tesla, falling over a cliff. And of course, the stock spiked since then. So great analysts, and in today's class, by the way, you're a financial analyst. Great analysts don't let the following influence them. They don't let the media get to them, right? They form their own opinions. They don't let people that sound very confident or speak gooder than them or than me get inside their head. They also don't they question things that politicians tell them as well. I love this graphic. I'm not a political person at all, but I thought this was quite funny. So just remember, in finance and in business in general, confidence does not equal competence. It's really important for me to stress that. So don't let other people influence your opinion in finance or business in general. And you got to be careful because CFOs and CEOs are the best salespeople in the world. And how do you tell if they're lying? Well, it's when they move their lips. I'm just kidding, of course. I just want you to be able to kind of filter the news from the noise. I want you to question financial data always and just form your own opinions. Don't let other people form opinions for you. It's really, really important. I remember early in my career, I worked briefly at a hedge fund called Kingdon Capital. And Mark Kingdon, who's the founder of the firm, really nice guy. He's a great guy. He came up to me and he said, "Chris, I really like this company, Computer Associates. What do you think about it?" And I said, "Yeah, I love it too. It's a great investment. We should definitely invest in the company." And the investment worked out only because Mark Kingdon, who's brilliant, came up with the idea. But at that age and stage of my career, I didn't have the chutzpah or the foresight to really do my own work. And I've become a better investor over the years as I do my own due diligence. And I don't let anybody influence me, and I don't want anybody to influence you as well. And it doesn't matter how little experience you have. You were born with a lot of common sense, so just use it. And don't let other people, get inside your head. So always form your own opinion. And you never want to talk to a management team right away when you're doing due diligence on a company. That's actually the last thing you should do. I know it sounds weird. Why do I say that? Again, CEOs or CFOs are the best salespeople in the world. Talk to them if you have to at the end of your investment process, at the end of your due diligence process, okay? It's important. All right, so let's talk about our foundation toolbox. So we're going to talk about quantitative stuff today, okay? I want you to look for trends in the data always, okay? Every single chart tells a story, okay? One data point doesn't make a trend. Remember, learn to enjoy reading financials like a good book, as dorky as that sounds. It can be a lot more fun if you do it this way, okay? So we're going to look at Oracle, okay? Oracle is this incredibly successful software company. They're one of the early pioneers with a database, which is basically where you store data. But I want you to kind of look at some charts and question the data. And we'll come back to Oracle later in this course as well when we do a case study on the company. Okay, so if you look at this company, between 2009 and 2011, looks like growth was amazing. But the reason growth was amazing, you got to question the data always, is because the years before that, you had negative revenue growth because the world was almost ending. We had the financial crisis at that time. And so you look at this and you think, wow, okay, man, I get it. They recovered, right? The world was ending, they recovered. Well, no. The reason revenue growth in this real scenario was very positive in those years is because they bought growth, okay? They bought a lot of companies, okay? They bought Sun Microsystems, which is a hardware company. They bought BEA. They bought Right Now. And before that, they bought a bunch of companies as well, including a company called PeopleSoft and Siebel and Hyperion. And so the organic growth rate for Oracle is actually negative. So there's growth and then there's organic growth. Organic growth is how much your company is growing without buying stuff or buying companies. Their organic growth is not positive. And so let's look at this chart as well. Their price earnings chart, you can see you've got 10-year multiple contraction. The PE in 2004, I remember I worked at Citadel at the time, it was 20 times earnings. And now it's a lot lower than that. And the reason is because the market caught on the fact that this company's not growing anymore, man. They actually bought a lot of growth. And so you've got 10-year price earnings multiple contraction. Okay, it's going down. Okay, great. So you got negative organic growth for Oracle. The company's done $50 billion in acquisitions since 2004. Okay, so let's talk about more quantitative stuff. You know, every model has got different drivers, different key data points you have to analyze. So with technology companies on the income statement, the driver can sometimes not just be revenue. Revenue can be the number of subscribers they have. Okay, so Facebook, you always want to analyze the number of subs they have. And, you know, right now it's $1.4 billion. There's not that much growth left, to be honest. And you look at revenue for other companies. You could also look at bookings. I won't go into too much detail on this, but bookings basically is you can only recognize revenue when you ship the product to the customer and they pay you. Sometimes customers will pay for a whole year or 2 years of stuff, right? And you can't recognize that revenue right away. So it becomes revenue, and then the stuff you can't recognize right now, it doesn't go on the income statement. It's not revenue. It goes on the balance sheet. It's actually kind of like a liability, and it's bookings. And then once you recognize it, it comes off the balance sheet, off of deferred revenue. Enough on that, though. Okay, we look at operating and gross margin trends, and we look for patterns. And we did this earlier on in this course as well. So when we look at balance sheets for technology companies, there's usually not much debt, if at all, especially for a software company, because you're just producing software and selling it on a CD or actually just selling on the open internet, right? There's no factories, right? Not that many, at least. And a lot of companies like Cisco that make hardware products, they don't actually make it. They outsource it. And almost everything that they make is made by somebody else, right? And then you look at a company like a Qualcomm, for example, an amazing company in San Diego. They don't produce anything. They have patents, and they charge people that use their patents now. So technology companies usually have incredible cash balances and very little debt. And we talked about bookings and deferred revenue already. Okay. So when we talk about cash flow statements with technology companies, they're not usually that relevant. And I know it's controversial, and they're not as relevant with most companies in tech, especially software and internet companies, because cash flow is usually the same thing longer term as net income. They converge. So cash flow statements are a little bit less relevant. And we talked about seasonality already. So what about valuation? So as I mentioned before, value investors are not that great at tech investing. And the smart money, this is worth repeating, models 5 years out. So again, before you invest in a tech company, or any company for that matter, ask yourself one basic question. In 5 years, is this company going to be more relevant or less relevant than it is today? Okay. And base your valuation today on earnings or revenue in 5 years from now, not this year or next year. Okay. And that will set you apart from all other investors, because all the other lemming investors will follow each other off a cliff and value companies on earnings this year or next year. Be different. Look out longer term. And this will give you the stomach not to be a tourist and pull a ripcord when one of the companies you're investing in has a bad day. Okay. Don't rent companies. Be an owner of a company. Okay. So what about non-technology company valuations? What about non-tech companies? How do you value them? Well, you use DCF, or discounted cash flow, right? And again, the smart money model's out 5 years, and you can use revenue, earnings, and cash flow multiples. And we're going to talk about more drivers later. So another important topic is the growth versus value spectrum. I kind of covered this before, but I want to revisit it because it's very important. Okay, so growth investors, okay, they are on this side of the spectrum. They invest in companies that are growing very quickly and are very expensive this year, but very cheap 5 years from now. Value are the dudes on this side, right, that only buy cheap stocks, right? So they usually don't buy tech stocks. They don't get it. Anyway, that's growth versus value. And you can find a wealth of information on publicly traded companies at sec.gov. And as nerdy as this sounds, I'm going to say it's an awesome website. It's amazing. There's so much cool stuff you can get from there. And you can just click in the top right-hand corner and just do a ticker search. So you could search, in this case, on IBM, which stands for Industry's Biggest Mistake. No, I'm just kidding. It stands for Itty Bitty Machines. And so what you can do is you can click through and you can read the 10Q, which is the quarterly report that by law publicly traded companies have to disclose, or the annual report, which is called the 10K. And there's just a wealth of information in these things, but we'll cover that later in more detail. Okay, so in terms of a quick recap of today's short lesson, we have a lot of great quantitative tools that we can use. And target price are usually based on estimates that you have developed 5 years from now. You want to look for trends, and you want to form your own opinion on all investments. Please don't listen to people that sound very confident. Don't listen to me. Form your own opinion on everything, please. And then go to sec.gov, and we'll do a lot more of that in the next class because it's an amazing reference tool for analyzing financial information and looking at risks, which have to be disclosed by law. Thank you. So I've got a topic that I want to quickly repeat before we move on to another session, and that is this. You can't underestimate the importance of networking. And I'm going to keep coming back to this because the relationships that you cultivate or you develop in business are more important than the product knowledge that you derive in business. Your ability to network is more important than the grades you get in school. It's whom you know, really not what you know. I know it's an old cliche, but if you're looking for a job, I want you to use LinkedIn, okay? And I want you to set up informationals, set up tons of informationals, okay? And I want you to do one every single week, okay? One every week. If you're working at a company and you're not happy there right now. If you're a student, I want you to set up one or two every day, right? Okay. So how do you do it? How do you set up informationals? And we've covered this, but I want to cover it again in a little bit more detail. Well, you find something in common with people on LinkedIn at companies you want to work at. So, for example, I'm going to have to move closer to the screen here because my eyesight's not as good as it was. Okay, so in LinkedIn, in this example, I typed in the word Moscow. Let's assume you're from Moscow, okay? And let's assume that you want to work at Apple. That's right. And so let's do a search for people that live within 100 miles of where I am right now that are from Moscow that work for Apple, okay? And you'll find actually that there's a bunch of people that show up. There's actually 20 results. That's pretty good. People from Moscow that work at Apple, okay? And you can even narrow it down and look at the universities they went to. And they might have gone to the same university as you did in Moscow. And you have to understand that people love helping students, and people love helping people that are from their hometown, that have something in common with them, right? I miss Canada. When people reach out to me and say that they're from Toronto or Mississauga, I always take the meeting. I want to help people. I want to help people that have similar backgrounds to me. I want to help everybody in general. But you'll never get ahead in this world unless you ask for help, okay? And remember that Steve Jobs video. If you don't, pause this right now. Go to YouTube and do a search on Steve Jobs Ask, A-S-K. It's worth watching it again if you already saw it. It'll change your life. People want to help you. You just have to ask, because most people don't ask. And culturally speaking, a lot of people in the Bay Area, a lot of my friends are from different countries, and they feel like culturally it's not appropriate to ask for something or to reach out and network this way. You got to break out of that mold. Break out of that mold and just ask, because people want to help you. Just ask. Be persistent on LinkedIn and ask to meet for coffee. Again, just ask. And the people on this slide are no smarter than you, okay? They are only successful because they network. That's right. They're only successful because they network. They are no smarter than you. Okay, I promise you that. Okay, no smarter than you. And so I want you to pause this, and I want you to go to YouTube again and do a search on Steve Jobs, no smarter than you. Okay, watch that video. Steve Jobs, no smarter than you. It'll change your life. Okay. Confidence. Confidence is not just an American thing. Why am I mentioning America and confidence at the same time? Well, I remember when I was a kid growing up in Canada in the 1980s. And I remember Japan was very strong economically speaking at the time, and they're still strong today. But I remember there was this fear in America that the Japanese were buying all their buildings and golf courses and whatnot, in that American students were 50th in the world in math and 50th in the world in sciences, and it was the downfall of the American empire or American innovation or whatever it is. But I've since realized, since moving to the States, that American students, whether or not they were born in this country, and please keep in mind that most successful entrepreneurs in this country, especially in the Bay Area, were born overseas. American students, whether or not they were born in this country, are number one in the world in the most important economic category, which is confidence. And with confidence, you've got the ability to take risks, to sell yourself, to sell an idea, to sell a dream, to be a dreampreneur. Okay? You have to have confidence. And if you have confidence, then everything else will fall into place. People, I guess, will assume you're competent as well. I'm not talking about arrogance. I'm talking about confidence and learning how to sell. And if you have issues selling, go back please, and watch the presentation portion of this course. Or take a video of yourself presenting and send it to me, and I'd be more than happy to offer my very humble feedback. I thought it was important to talk about confidence as well, as it's something that's not covered in business schools. Thank you.